Record keeping is necessary for intermediaries and its associated entities, collectively, institutions, as it explains and reflects the financial position and operation of the business. The practice enables a true and fair view of the financial affairs by checking on the profit and loss accounts and balance sheets. Furthermore, it accounts for clients' assets that the institutions receive or hold and reconciles monthly with all movements of the assets to be traced. In general, the intermediary must maintain records of all money received or paid, income and expenses, and transaction orders or instructions, along with the relevant details of the individuals involved. The records should include the names of the client and intermediary, date of the transaction, charges incurred, and proceeds received. Additionally, the records should provide information on assets, liabilities, financial commitments, contingent liabilities, securities held by the intermediary, bank accounts, off-balance sheet transactions, and positions. It is also important to keep contracts, evidence of client instructions and authorizations, and proof of professional investor status if applicable. For Type 1 regulated activity, dealing in securities, the licensed or registered intermediary should keep record of all underwriting and subwriting transactions, including the dates of transactions. For leveraged foreign exchange trading, which falls under Type 3 regulated activity, it is necessary to maintain records that adequately capture the details of the recognized counterparty. Additionally, daily records should be kept for each client account, including the market value of each open position at the end of the day. These records should also include information on the interest rate differentials charged for long or short positions, as well as the bid and offer prices quoted. It is crucial to note the price at which the contract is executed and the bid and offer prices at the time of contract execution, as quoted publicly by a reputable financial information services organization. For securities margin financing, which is classified as Type 8 regulated activity, the intermediary is required to maintain specific records. These records should include the margin policy and lending policy provided, as well as details about the securities and client collateral deposited with another party under an arrangement involving collateral interest. The records should also include information about the individuals with whom the securities are deposited, including the quantity and market value of the securities held for safekeeping and used as security for margin financing. Furthermore, for each client, there should be a record indicating the market value and margin value of the securities collateral deposited, as well as the combined market and margin values of the particular securities collateral. Additionally, the record should include details of any margin calls made during the course of the financing arrangement. For asset management, which falls under Type 9 regulated activity, the intermediary must maintain records that clearly indicate the clients for whom they hold assets and liabilities. These records should provide comprehensive information about the assets held on behalf of each client and any corresponding liabilities. The institutions are required to maintain all records in written form, either in Chinese or English, or in a format that allows easy accessibility and conversion into written form in either language. They should also implement necessary procedures to prevent any falsification and ensure that any falsification can be easily detected if it occurs. The Securities and Futures Commission typically expects institutions to retain the original copies of trade-related and non-trade-related documents. However, it is acceptable to maintain records in electronic form as long as they can be easily converted into written form. In some cases, client orders or instructions may be communicated over the phone. To avoid any potential disputes, it is advisable to obtain written confirmation of such instructions. In accordance with the Securities and Futures Keeping of Records rules, institutions are required to retain records for a minimum period of 7 years. Specifically, transaction orders and instructions should be kept for at least 2 years. For daily compliance checking, it is expected that the underlying records be retained for a reasonable duration to ensure an adequate audit trail. Additionally, it is important to retain important and necessary compliance records for a period of 7 years. Even if a client has passed away or closed their account, the 7-year retention period should still be counted from the date prior to the account closure. The institutions are required to promptly provide written notice, within 1 business day, on behalf of any non-compliance incidents they become aware of, regardless of the severity of the incident. If the intermediary or associated entity violates the record-keeping rule without a reasonable excuse, they may be held liable on conviction and face a fine at level 4. In cases where the offense is committed with the intention to defraud, the penalty can be more severe. This includes a potential fine of up to 1 million Hong Kong dollars and a prison sentence of 7 years upon conviction on indictment. Alternatively, for summary conviction, the penalty may involve a fine of up to 500,000 Hong Kong dollars and a prison sentence of 1 year.